Let's zoom out for a second. When you hear about missile strikes, airspace alerts, or naval tension involving Iran, it can feel distant. But here's the reality. If escalation continues in the Gulf, especially near the Strait of Hormuz, the global economy doesn't just react, it shifts. And the shift can show up in oil prices, inflation, shipping costs, stock markets, even your grocery bill. So today, we're breaking down exactly how that happens. No hype, no panic, just the economic chain reaction. There's so much noise in the world right now. Headlines move fast, markets move faster, and somewhere between breaking alerts and social media clips, it's easy to lose the bigger picture. Here, we slow it down. We connect the dots between geopolitics, economics, and the systems that quietly shape our lives. Because when something happens in one narrow waterway, thousands of miles away, it can still affect your gas prices, your groceries, and your investments. Let's zoom out. The Strait of Hormuz is a narrow waterway between Iran and Oman. But here's what makes it powerful. Nearly 20% of the world's oil supply passes through it. That's not a regional detail, that's a global dependency. Major exporters like Saudi Arabia, Iraq, Kuwait, UAE, Qatar all rely on this passage to ship energy to Asia, Europe, and beyond. Now think about that. If tensions rise, if insurance premiums spike, if ships hesitate, the market reacts before anything even closes. Oil markets are extremely sensitive to risk. Even rumors of disruption can push prices higher. Why? Because traders don't wait for supply to disappear. They price in the possibility of disruption. When oil rises, fuel costs increase, airlines pay more, shipping companies pay more, manufacturers pay more, and those costs eventually reach consumers. That's how geopolitical tension becomes inflation pressure. We've seen this before, in 1973, in 1990, in 2022. Energy is the bloodstream of modern economies. When it tightens, the body feels it. Now let's move beyond oil. Shipping routes matter just as much. If tankers or container ships avoid the Gulf, routes get longer, fuel usage increases, delivery times stretch, insurance costs rise. That doesn't just affect oil. It affects electronics, food supply chains, raw materials, construction inputs. Global trade works because it's predictable. Conflict introduces unpredictability, and unpredictability increases cost. We saw during the pandemic how fragile supply chains can be. Now imagine adding geopolitical risk to that equation. Markets don't like uncertainty. When geopolitical risk rises, stocks often dip, investors move into safe haven assets. Gold can rise. Government bonds attract capital, volatility increases. Even if physical supply isn't disrupted yet, financial markets prepare for worst-case scenarios. That can affect retirement funds, corporate investments, and business expansion plans. Capital becomes cautious, and caution slows growth. Now here's where it gets interesting. Not every country feels this equally. Energy importers, especially in Asia, are more exposed. Countries like China, India, Japan, South Korea depend heavily on Gulf energy. For them, instability in Hormuz isn't theoretical, it's strategic. Meanwhile, energy producers may temporarily benefit from higher prices. So conflict doesn't just create chaos, it reshuffles economic leverage. Let's simplify this. There are three broad economic paths. Limited escalation markets spike briefly, then stabilize. Short-term volatility, manageable inflation pressure, sustained tension. Oil stays elevated, shipping costs remain high, global growth slows modestly, major disruption in Hormuz, significant oil supply shock, sharp price spikes, inflation surges again globally. Central banks face renewed pressure. The difference between these paths isn't economic, it's geopolitical. Here's the bottom line. Modern economies are interconnected. A regional conflict can influence fuel prices worldwide, affect grocery bills, shift stock portfolios, change central bank policy. The world runs on energy, and energy runs through geography. That's why when tensions rise involving Iran and the Strait of Hormuz, the global economy pays attention, not because panic is inevitable, but because risk has a cost. And in global markets, risk is priced instantly. And this is the part most headlines won't tell you. Economic impact isn't just about explosions or announcements. It's about probability. It's about risk. It's about how markets calculate uncertainty in real time. So the real question isn't just what's happening today, it's how the world adjusts tomorrow. If you found this breakdown useful, stay with us. We'll keep connecting the dots calmly, clearly, and without the noise. Because understanding the system is always more powerful than reacting to it. Until next time.